Interest rates are cut again. The Fed recently voted to cut those rates. We're going to talk about what that change means for you, your investments, and your retirement savings. Welcome to our show. This is What Your Money Would Say with Andrew McNair. He's founder and CEO at Swan Capital, and he's here to fill us in on the background and shed a little light on what we can expect now. Thank you so much for joining us today. I am Lou Ann Fulmer. Here's our phone number, 800-848-8768. That is the number that you can call or text if you want to just text. If you're a texter like me, text the word SWAN and you can get on their calendar a complimentary visit to talk to Andrew and our awesome team at Swan Capital about your questions. You can also text the word book. Andrew has a couple of books that you can get complimentary. That number again, 800-848-8768. Find us online at swan-capital.com. Andrew, so excited to get started with you today.
Oh, me too. We have so much to unpack and talk about.
I know, we do. Okay, so, interest rates now have been cut. I want you to kind of fill us in on that background. We've been hearing it, in the news. We knew it was going to happen. You knew it was going to happen.
I mean, even in 2023, they were like, we're going to have 6 rate cuts in 2024. The Fed is going to come, put their cape on, and save the day. And we now are obviously, in October, and we've had this one rate cut of 0.5%. There was discussion of a 0.25% cut, but the Fed chose, in this case, to be more aggressive. And this really is the benchmark rate, which before the cut was at the highest point in 23 years. So it was that high because of several rate hikes that were introduced to obviously combat the inflation that we've seen from the pandemic and afterwards and the aftermath of that. And so we haven't got 6 cuts by any means. And I personally always like to make sure everyone knows my opinion. I think the Fed should keep interest rates higher. I know that's very controversial. I know people want the Fed to lower interest rates, but what's best for the economy is keeping these interest rates higher to get rid of inflation once and for all.
Okay, very good. So I want you to hear Jerome Powell. He's the chairman of Federal Reserve. I think everybody knows that. But this is what he had to say on the recent cut. So here he is.
The Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by 0.5 percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%.
Okay, so what's your reaction to that?
Yeah, Lou Ann, to translate all of that, it's basically saying that there's a dual mandate, that Jerome Powell wants inflation to stay ideally at 2%, and he's not willing to let the jobs market crash to make sure that we keep inflation at 2% or under 2%, that they'll be okay with a little bit higher than 2%. So he's really balancing and juggling, which, again, I personally believe that the Fed and the emphasis on the Fed is not healthy for a capitalistic economy. The Fed, the government, does not decide interest rates. The market should be deciding interest rates. Unless you want to live in a socialistic, communistic government. I mean, that's what China does. China tells what the interest rates, it tells what's going to be available for the private markets that exist within China. And so I don't think it's a healthy trend for us to have such an emphasis on the Fed, yet every market analyst, every financial advisor, every mortgage broker keeps such a close eye on the Fed. And I think it's very dangerous because you are manipulating artificially the economy. And that's where Adam Smith's Economics 101, the invisible hand, starts to slap your hand, because you need to let the market do what it needs to do.
Okay, very good. I love that. I like hearing your input there. Talk about how these lower interest rates can impact retirees. That's our main focus here.
Yeah, I think a lot of clients were really enjoying the mirage of higher interest rates in this desert of inflation. So they finally saw a money market, a CD paying 4% and 5%. And you heard it right here on the radio show. I kept on saying, this is a mirage. This is a little oasis, but it's going to dry up, and that well is going to dry up eventually. And you're going to still be in the desert of inflation. Whenever money markets or CD rates go up, again, that is a canary in the coal mine, just really letting you know how bad inflation is. No one digs up a CD from their great-grandmother's estate and says, wow, we've made it rich because I found a 100-year-old CD. No, that's not what they were designed to do. So again, I know a lot of retirees have taken a lot of comfort knowing that interest rates are higher, but that is not the long-term tool to beat inflation. So we have to make sure that we do, of course, have emergency funds in place, maybe 6 months to a year of cash set aside, but we also need to have inflation-fighting assets such as owner finances on a house you've sold, real estate, equities, any asset that over a long term has beat inflation. And that is what I think is really important to emphasize for a retiree.
Okay.